CIMB saw its bottom line jump 26.3% in the second quarter. Net profit stood at 1.1 billion ringgit as compared with nearly 873 million ringgit last year. Revenue rose 10.9% to 4.3 billion ringgit, up from 3.9 billion previously. For its first half, earnings improved by 35.3% to 2.3 billion ringgit, while top line rose 13.8% to 8.7 billion ringgit. The group says this is thanks to loans growth across its segment, improvement in net interest margin, and the revived capital market. It declared an interim dividend of 13 cents a share. CIMB Group CEO Zafrul Aziz says the group is cautiously optimistic for the second half of 2017. This is given the strong GDP growth for Malaysia and Indonesia and the expected gradual improvement in Singapore and Thailand. It all signals increased regional activity and improved capital markets. MMC Corp didn't do well for its second quarter, with earnings falling by almost half. Net profit was down 49.7% to 62.92 million ringgit from 125.02 million previously. The group said this was mainly due to the absence of gain on sale of land, substantial completion of the MRT in 2016, and lower contribution arising from outages at Tanjung Bin Power Plant. Quarterly revenue was also marginally down 0.6% at 944.4 million ringgit compared with over 950 million a year ago, also due to the substantial completion of the KV MRT SBK line. Going forward, MMC says it remains positive of its prospects, driven by the stable performances of its operating companies and ongoing projects, saying that it expects the Ports and Logistic Division to register higher revenue across all ports following the completion of acquisition of Penang Ports. While for engineering and construction, earnings will be sustained by ongoing projects, namely Langatu Water Treatment Plant and Pan Borneo Highway. CIMB had a slight tumble in its second quarter. Earnings slipped by about 5.5% to 135.7 million ringgit compared with 143.7 million ringgit previously. However, revenue rose 6.8% to 943.2 million ringgit versus 882.4 million last year. Looking at its first half results, net profit inched up by 2.8% to 286.8 million. Revenue was 5.1% higher at almost 1.9 billion. Looking ahead, the group expects the banking industry to remain resilient despite the challenging operating environment, with moderate loans growth of between 5 and 6%. It says while competition for deposit and margin compression continue, sufficient liquidity in the banking system should support financing activities. Masing saw a slight improvement in its bottom line for its second quarter. Net profit inched up 1.8% to 90.4 million ringgit compared to 88.82 million a year ago. Quarterly revenue, however, fell 6% to 727.1 million ringgit, down from nearly 774 million ringgit previously. But the numbers for the first 6 months were lower due to higher selling, marketing and admin expenses. Net profit for the 6 months was 1.6% lower at 180.8 million ringgit, while revenue fell by just over 2% to 1.45 billion from 1.48 billion last year. Masing said the group had achieved property sales of 819.3 million ringgit in the first half and is looking to launch more properties below the 500,000 ringgit range in the second half to meet current market demand. Masing is targeting sales of at least 1.8 billion ringgit for the full year. Group MD Leong Hoi Kam noted that Masing is on the lookout for more strategic land banks, especially in the Klang Valley. In 2017 alone, the group acquired 4 new lands, 3 in the Klang Valley and 1 in Bukit Mertajam, Penang, which have a combined GDV of 4.3 billion ringgit. The minority shareholder Watchdog Group agrees with Scomi Group's rationale for consolidating its businesses after taking into consideration its poor financial performance. In its weekly newsletter, the Watchdog Group says it hopes that after going through the proposed merger, the Scomi Group could consolidate and streamline its organization structure so that it would be able to move forward to look for new partners and funding in order to turn around its business as soon as possible. On August 21st, Scomi announced a plan to merge its 2 tightly controlled subsidiaries, Scomi Energy Services and Scomi Engineering, via a share swap. All 3 are currently loss-making. The initiatives are expected to raise cash proceeds of at least $50 million USD.